All right, so stop me if you've heard this one before. And actually, this topic is fresh on my mind because just today I was having this exact discussion with some potential home buyers. They are self employed, they're looking to buy here in Florida, and they're in the thick of strategizing exactly how they should file their taxes this year. So here's the scenario we talked about. You've had a banner year in your business. You've crushed your revenue goals. Your gross receipts are looking fantastic and you're feeling ready to buy that dream home. So you sit down with your CPA in February or March, and the goal is simple: pay as little in taxes as possible. So you write off everything: the car, the home, the office, the meals, the depreciation, and then you high five your accountant because you owe Uncle Sam almost nothing. But then you call me in April to get pre-approved, and I have to be the bearer of bad news. By winning against the IRS, you might have just disqualified yourself from a mortgage approval. So this is the classic tug of war: the tax return versus the mortgage application. Let me introduce myself. I'm Taylor Ard, NMLS 370856, and for 21 years I've focused on providing a dedicated one-on-one mortgage experience to help you move from application to closing with total clarity and confidence. So today we're doing a deep dive specifically for my self-employed business owners. And that includes consultants, freelancers, realtors, 1099 contractors. We're going to talk about how you file your taxes and how that directly impacts your ability to buy Florida real estate, what add backs can save your deal, and the alternative options if you've already filed. So let's clear up the misconception, maybe the biggest misconception in the mortgage world when it comes to tax filing, and that is that lenders do not look at your gross revenue. We look at your net qualifying income. So to take an example, if your business revenue was $200,000 last year, but you wrote off $150,000 in expenses to lower your tax bill, in the eyes of a conventional underwriter, you didn't make $200,000, you made $50,000. And then when we calculate your debt to income ratio, we're using that $50,000 figure. So if you're Schedule C as a sole proprietor, I'm looking at line 31. That's your net profit, right? That's the starting point of your borrowing power. You cannot afford to have your pre-approval shaky because the tax returns don't support the amount of debt you're requesting in that loan amount. So does this mean that you should not take deductions? Well, absolutely not. You run a business, but you need to understand which deductions hurt your mortgage chances and which ones actually don't matter. This is where having a loan officer with 21 years of experience matters. A rookie might look at your line 31 net profit and say, sorry, you don't qualify. But I look at your return and I look for add backs. These are expenses you write off for tax purposes that I can legally add back to your income to boost your qualification. Let's look at the big three. Hop down here. Depreciation. This is paper loss. You didn't actually write a check for the depreciation on your equipment or property. It's an accounting maneuver. I can typically add that entire amount back into your income column. There's also business use of home. If you deducted a portion of your mortgage or utilities for a home office, that's great for taxes. For me, that's not a real cash outflow that affects your ability to pay a new mortgage, so we add it back in. Also, there's mileage and depletion. Depletion different from depreciation. If you claim a huge mileage deduction, that reduces your taxable income significantly. But since it's often a standard rate deduction rather than actual cash spent, we can often add a portion of this back to strengthen your file. It's about a third of it, if I recall correctly. So, do you see the difference? A good LO knows how to reconstruct your income legally and ethically to satisfy Fannie Mae and Freddie Mac guidelines. This can be the difference between a $300,000 approval and a $500,000 approval. Let's talk a little bit about the 2-year rule. Generally, conventional loans require a 2-year history of self-employment. We usually average your income over the last 2 years. Sorry, I've skipped down too far. Here's the trap. If your income is declining year over year, underwriters get nervous. They might only use the most recent lower year. And if your income is increasing, we generally take the average. So, crucial tip, if you bought a home in Florida 3 years ago and are looking to upgrade now, realize that insurance and property taxes have changed. Your buying power needs to be stronger today than it was in 2021. This is why before you file your 2025 returns this season, I want you to call me and we can run the numbers based on even a draft. We can see if your planned write-offs will drop you below the threshold for the house that you want. Now let's talk about alternatives, plan Bs. If the reported income doesn't shake out, or what if your CPA is a magician and your taxable income is legitimately zero? Are you locked out of the Florida housing market? No, this is where non-QM, that stands for non-qualified mortgages, those products come in, specifically the bank statement loan. And for these loans, toss that tax return in the trash. We don't even look at them. Instead, I ask you for your last 12 to 24 months of business bank statements, and we look at your total deposits, your gross revenue flowing into the bank. We apply a standard expense factor, say 50% for overhead, and we use the remaining 50% as your qualifying income. These loans are pretty big. They're massive for self-employed entrepreneurs. Yes, the rate is slightly higher than a standard conventional 30-year fix, but it gets you into the home. It gets you the keys. And remember, you can always refinance down the road when your tax returns show more income. In Florida, specifically, where self-employment is booming, these bank statement programs can still win the approval. So here is my advice. Do not view your mortgage and your taxes as two separate events because they're tied together. And if you're thinking of buying a home in the next 6 to 12 months, do not file your taxes yet. Let's get on a brief strategy call. You can send me your draft returns and your P&L. Let me do the math. I can tell you, hey, if you write off that extra $20,000 in equipment, you might be losing $100,000 in purchasing power. You can then decide with your CPA what is more important to you this year, saving $5,000 in taxes or buying the home that you really want for your family. Again, I'm Taylor R.